Good morning. I'm David Wessel. I'm director of the Hutchins Center on Fiscal and Monetary Policy here at Brookings, and I'm very pleased to welcome you to this event, which we're sponsoring jointly with the Tax Policy Center, which is itself a joint venture of the Urban Institute and the Brookings Institution, on dynamic scoring. Now, for those of us who've been in Washington for a while, kind of coming to an event on dynamic scoring feels a little bit like this person will say this, and then this person will say the predictable thing, and Marty Sullivan will say this, and Bob McIntyre will say that, and Jane Gravel will say this. So we'll probably have a little of that today. But our goal today was to move a little bit beyond the conversation about whether dynamic scoring is either the best thing to ever happen to Washington or the worst thing to ever happen to Washington, and instead focus a little more on what does it actually mean and how do you do it. And this is, of course, newly relevant because of the House rule, which I printed out and forgot to bring down, but which requires the Joint Tax Committee, which does taxes, and the Congressional Budget Office, which, despite what some people think, does not score taxes, to take into account the macroeconomic effects of policies and their feedback effects on revenues and spending. And this is hard. There are a lot of people who think it's long overdue. There are some people who think that it will lead to bad fiscal policy over time. And what we're going to focus on today is exactly how it would be done, what assumptions you'd have to make, what are the challenges that the JCT and the CBO staff face in doing it, how can it be best presented so that members of Congress and the rest of us have a clue as to what the analysis does. So this is a bit of an experiment and moving beyond the basic pissing contest in Washington to looking at a little bit of facts and information. Let me just tell you briefly how we're going to do this today. We're going to start, I'm going to moderate a conversation between Len Berman and Doug Holtz-Eakin about the big picture. Len, of course, is now the director of the Tax Policy Center, and he also was the Deputy Assistant Secretary for Tax Analysis in the Treasury in the late Clinton years, and has also worked at CBO. Doug Holtz-Eakin, who's now the head of the American Action Forum, was the director of CBO from February 2003 to December 2005. So both of them have grappled with these issues firsthand. Following that, we're going to turn to something we're very pleased to have, a presentation by the staff of the Joint Tax Committee on how they actually look at how they do this and the mechanics, followed by a discussion that my colleague Bill Gale, who's one of the co-directors, who is the co-director of the Tax Policy Center, will moderate. And then following that, and you can't leave before the last event, I'm going to talk with Donald Marin, Jared Bernstein, and Steve McMillan about the application of dynamic scoring to bills other than tax bills, which is also required in certain circumstances by the new House rule. So with that, let me invite Len and Doug to come up and we'll get started. No. I should mention that if we can keep this on time, we're going to have questions after each of the three panels. And in case you didn't notice, there's TV cameras in the back. One is for our webcast, so there's people watching this live, and it will be archived on our website. And the other is C-SPAN. And we also have on our website a little annotated bibliography that my colleague Brendan Marchuruk made that has references to the official documents of JCT and CBO on this, as well as things that have been written by each of the people who we have as panelists today. So, Doug and Len, let me get started with you. Thank you for being here. And Doug, I want to start with you, and I wonder if you could describe to us a little what was going through your mind when you were at CBO and you decided that it was appropriate to do a dynamic score, that is to factor in the macroeconomic effects of the president's budget, and what did you learn from the exercise?
So it started actually prior to my arrival at CBO. It became pretty clear during the selection process that this was something that was important to the members, both sides of the aisle, and both sides of the Congress. And so, I went into CBO, basically with the belief that it was a good thing to sort of look at a policy change and find out all its effects. It didn't make any sense to me to exclude the growth effects and do everything else. And so it's a matter of principles. You want to look at before and after and everything in between. Then the question became, when do you do it? It seemed to me that the president's budget was the ideal place to do it because it's the most fully specified single set of policy initiatives. You don't have to worry about missing pieces very much. There's still some things you have to worry about. And so that seemed like the right thing to do. It also gave you the right comparison because every president's budget is dynamically scored. Right? If you read them, for this president, Bush, Clinton, it always says these numbers are contingent on full implementation of the president's plan. So that's a dynamic score. I promise you the staff never proposes stuff that won't make the economy grow. Never. It's unbelievable. And so that was the right apples-to-apples comparison, in my view. And then the question became, how do you do it? And that was something that was, pretty uncharted. There were lots of different formal economic models that one could use for guidance. And I don't think you should think of those as anything other than guidance. This isn't a mechanical exercise. You have to use the models for some help, but you never have everything in the model that the Congress or president proposes. I mean, those guys are incredibly clever, so there's always things being proposed that aren't in the models. So you use them for some guidance. And then the last issue, which came up again and again, was the presentation. Right? Sort of how do you present the results and how do you communicate them? And there, I think we got sort of a really good solid F because, at that time, substantively, there were the 2003 tax cuts, which had some sort of fairly straightforward pro-growth supply-side effects. And then there was the Medicare prescription drug bill, which is not exactly a pro-growth policy. And when we put out the results, we basically had a modest net effect. I thought the Congress would conclude that, gee, it's not a good idea to offset this growth policy with this big new spending program. Instead, they concluded we did it wrong. That was it.
Len, so it seems obvious that Congress should consider the macroeconomic effects when it's considering a major piece of tax legislation or spending legislation. So I think the question is, what are the pros and cons of actually folding that into the score? That is the official score that's used to decide whether a particular piece of legislation will comply with the reconciliation or some other target.
Well, the pros of including a dynamic score is that, basically it removes a constraint on estimators. If they actually knew what the macroeconomic effect was, they could improve their estimates by including it. The con is that there's so many cases when they actually have no idea, and a lot of cases don't even know the sign of the effect. There's, the models themselves are these kind of stylized general equilibrium models or reduced form models, which means basically they're trying to account in a very kind of aggregate way how, say, capital and labor affect the economy and how taxes on capital and labor affect investment and work effort. Those are always based on estimates that are themselves very uncertain, and they aggregate just so much information. And the models, unlike, one of the issues is, well, there's uncertainty in every estimate, right? The president proposed last week that we should tax capital gains at death. Well, we've never taxed capital gains at death. We don't know what capital gains at death are. But in that case, we have lots of data. We have data compiled by the Federal Reserve Board Survey of Consumer Finances on how much assets, how much capital gains people have in their portfolios. We can make an estimate of probability of death. We can have some idea of what unrealized capital gains are at the time of death, and then we know what the tax rate is. We could calculate roughly what the revenue estimate would be. It might have a big variance on it, but first of all, we know that it would raise revenue at least before, well, actually, in that case, I think you could say it would raise revenue certainly before including any kind of macroeconomic effects. And then if you were to apply dynamic scoring to that issue, in the models, it would say, well, we're cutting the tax rate we're raising the tax rate on capital. There'd be less saving, less investment. That would hurt economic growth. In the real world, what we're doing is we're raising the tax rate on capital, but we're also removing the single biggest loophole in the individual income tax, which results in a huge amount of unproductive tax sheltering. And we don't have a good idea of how important that is. We know that there's a whole giant industry that's devoted to taking advantage of the zero tax rate on capital gains if you hold them until death. And different, depending on the assumptions, you could conclude that that was good for growth or that was bad for growth. I actually don't know what the answer is. But the problem is that, in this case, there are going to be people who believe really, really fervently that there's one answer or the other answer. There would be enormous pressure on estimators in that case. And there are lots of examples like that. They did an analysis of the Tax Reform Act of 1986 after it was done. I think it was Alan Auerbach did this. And that was a policy which all of us working on tax reform were convinced that it was good for growth. Larry Summers, after the fact, said, no, it's bad for growth because it raised the overall tax rate on capital. It also leveled the playing field, removed a lot of distortions among different kinds of assets. The net effect was probably zero, but it's really hard to tell.
All right, but wait a minute. So first of all, the rule says to the extent practicable, CBO and JCT should do this. So presumably that gives JCT the right and actually the responsibility to say if something really exceeds the capacity of human knowledge to just say we don't know. I mean, I'm sure that's difficult, and I'm sure that won't make a lot of proponents of bills happy. But if we had to wait until we have perfect knowledge before we use these things, that seems like an unreasonable standard. So are you afraid that they'll be pushed into saying more than they know, or that they just don't know enough to ever do dynamic scoring? What's the...
I just looked down at my notes on that specific issue. I said, absent political constraints, this is a good thing. It's removing a constraint on the estimators. My concern is exactly what you're talking about, that they'll actually be pushed, that Congress will be mad if most of the time they say we don't know, but actually I think that's the right answer. The other thing is that we actually do want Congress to pay attention to the macroeconomic effects of policies. And I'm very sympathetic to the people pushing for dynamic scoring because we know that numbers actually carry more weight than just saying this is good for growth or this is bad for growth. But the problem is that there's so many cases when the answer should be no, we don't know.
Okay.
So
we know enough to do this?
Yeah. We know just as little about this as everything else we score. And so...
No, I think the argument is we know a little less about this. And
I'm not sure that's true, honestly. I mean, so we know that the precise answer of zero is exactly wrong. Right? There's no virtue to being exactly wrong by knowing that there might be an impact and saying, we'll ignore it. So I think sort of doing this makes sense. Remember, this bill would probably not get dynamically scored. It's not big enough, the one you're worried about. This is only done in the House rule and it should only be done for major pieces of legislation that have large, predictable impacts. They're budgetarily important. So that's sort of one observation.
Let's just define that. So the rule says...
it's got to be 0.25% of GDP in any fiscal year to get to merit consideration.
To change spending
so that's
or
like 40
taxes
billion. That's like
by $40 billion, right? So most pieces of legislation is not going to apply to it.
Right.
It would
so in the
apply
last
to
Congress, it would have been 3.
Right.
So
the extenders have been very fun to dynamically score.
This is a sideshow for most of the things, right? Most of what Congress does is rename post offices, and that's not going to turn out to be a big deal. So it's not going to happen very often. You do want to look at it. It is always a scoring issue to look in the research literature and sort of see what the consensus tells you. And in many cases, you don't know much. And I have a long list of things in conventional scoring that are comparably uncertain to what we're facing here, or worse, quite frankly. And in those circumstances, there's a lot of zeros that get put in there. I mean, if you think back to the ACA, the
Affordable Care Act.
The Affordable Care Act, advocates desperately wanted CBO to score the preventive measures as saving money, and they didn't, and they were mad about it. And in my time, Congress was mad about decisions we made, and I don't think there's anything that changes political pressure here. I mean, it's the case that scoring matters, and that there will be disappointed advocates on all sides of scores. I mean, so I don't think that's different. I think that the important thing to recognize is that the staffs are not slaves to these models. It's not like they have to say the model did this and that's the number. Scoring is a judgment science and a judgment art at the same time. And we should hire high-quality people at the JCT and in the CBO, and we do, and we should respect their judgment, and they should describe the way they arrived at the bottom line. This is not some slavish, policy in, number out exercise. That's not the way it works.
But I guess I disagree with the idea that this is just like doing other scores. The vast majority of the things, certainly on the tax side, that Congress scores basically involve, well, first of all, there are data.
Because we've done these things before.
Or, like, say, take the case.
Can I just say something about that? CBO and JCT are most important where there's the least data. When we did the Medicare Modernization Act at CBO, there was no financial product in nature that gave seniors financial protection against the cost of their outpatient prescription drugs. Zero.
But
So
you actually did have data on how much they spent on prescription drugs.
Sure, but I mean, the point is, when it matters the most, you are in the end making some judgments because you're not like you're changing something you've done 1,000 times before. So it's important in those circumstances to recognize you're always going to have a lot of uncertainty. That's all there is to it.
But when you're doing those kinds of estimates, you do have data. Typically, it involves a calculation based on at least some data and maybe an assumption of an elasticity. In the case of macroeconomic scoring, you've got a variety of different models that you could use to produce wildly different estimates. In a lot of cases, you don't even know, you don't have any good basis for the parameter estimates in those models. I'm not saying that we shouldn't try to do this. I'm just saying it's a lot harder than most of the estimates that Congress.
Let me turn to how. So they're going to do it. And they're going to do it for big bills. And we've learned a little bit. We saw CBO did basically a dynamic score, the ingredients of the dynamic score in an immigration bill. They could talk about labor supply. That was one that was measurable. But as Len points out, some of these things are going to be a little tricky. I can't imagine that with all the things they had to estimate in the Affordable Care Act, if they had to have dynamically scored that, that would have just made it harder what the labor supply effects are. So, Doug, you said that you thought you communicated the dynamic score that you did in 2003, 2004 poorly. What advice do you give to JCT and CBO today as they enter this brave new world?
I think there's a big advantage to actually putting it into the formal score. When it's advisory, and we had this range of estimates coming out of a range of models, you're basically out there trying to give a sort of master's level graduate course in macroeconomics in 3 minutes in front of committees, and that's just not feasible. If you put it in the score, you do have to come up with a number, right? And they may or may not like that number, but you do have to come up with a number. But it now matters. And it doesn't matter when it's advisory. It matters when it's the number. And now they're going to want to know about the number. And everyone out there in the research literature is going to want to say something about that number. They might not like it. That generates additional research on the issues you care about. It forces the staffs to come to terms up there with the number and the economics underneath that number. That's all beneficial. It might not be perfect the first time, but putting it into the process actually kicks off a dynamic that I think, no pun intended, is actually beneficial. We learn more about the public policies because the numbers matter. When they're advisory, it's not the same.
So in terms of the presentation, I think that's really important. And I know that JCT and CBO have thought a lot about this. I mean, one thing is I think you should show the static as well as the dynamic estimate so there's an idea about how much the macroeconomic effects are changing changing the results. The second thing is it's really important to be transparent about the channels through which the growth effects are likely to occur, are believed to occur in the model. I know that, it's JCT and Treasury and CBO get a lot of pressure for the assumptions they make, and they often don't want to talk too much about what's in their models when they're uncertain about them. This is a case where you really are telling a story, and there are alternate stories that are consistent with it, and it's important to be transparent. I would follow the model of the Capital Weather Gang. I was actually checking this morning to see whether we were going to be snowed out, and they put out a forecast, and their forecast includes, in their discussion, the level of confidence, low to medium, medium to high. There are some things on which everyone would agree that these would be good for growth. Maybe we're not sure about we won't be sure about the magnitude, but at least we're sure that there's something going on. Other cases where it's really, really ambiguous, and I think it would be important to do that. One advantage of doing this is that I think it might be a chance for the scorers to tell Congress that deficits, particularly in the context of an economy that's close to full employment, the deficits have a cost, and that surpluses might be a good thing to think about. And you might be able to build in from these models some kind of a deficit penalty or a surplus bonus. That would be another level of hand-waving, but I think it would kind of come out of some models. The other thing, Doug talked about researchers out there. It would be really nice if Congress would actually try to put some money into research to try to measure these things better. One problem we have in macroeconomics is that the macroeconomics related to real-world policy has very little attraction for academics because it's really, really hard. You have to do a lot of hand-waving. So they focus a lot on these.
Something academics never do.
No, they never do. But the problem is you can't just lay out a little model, estimate a regression, and find the estimate for how to taxing capital gains at death affect the economy. And finding a way to encourage academics to try to answer real-world macroeconomic questions as opposed to the kind that lead to Nobel Prizes would be really helpful.
I'm not sure. This is a different conversation, but I'm not sure that we're in a great place if it's going to take Congress to encourage academics to research.
I was just talking about money.
I have wandered into another world.
Yeah, we're not talking there. We'll have a higher. Let me just ask you one thing before we turn to questions. So, if I propose a tax cut on investment that's huge, you and I would probably agree that would be good for growth. But people would say, well, it kind of depends. Are you going to pay for this? Is it going to be financed or not? If I get the bill on my desk and I'm at JCT, do I have to decide, are they going to pay for this somehow? Or do I have to assume that there's some negative effects in 10 years when we blow a hole in the deficit?
So again, the key in scoring is to just recognize it's not forecasting.
But don't you have to make a forecast about what the deficit's impact is before you make a macroeconomic?
You wouldn't. No good forecaster would take the March baseline and use it for a forecast in November. But in scoring, you do that because you want to treat all bills the same. So it's not forecasting. It's scoring. And that means treat all bills the same so you can rank them correctly. And that means that if you're going to, and this is a big part of what goes on in static scoring, is both budget committees, OMB, the staffs at CBO, Joint Committee, everyone sits down and figures out what rules will we use for consistency in scoring to make sure we give you.
So in other words, they have to decide if they're going to decide in the out years whether we're going to have a deficit of.
Yeah, I mean, and then use the same procedures for all pieces of legislation. That's the key.
Yeah, but raise your hand if you have a question so Mike can find you.
So, I mean, what happens with the deficits come out of policies is really important. I mean, if you think the consequence of the 2003 tax cuts, which you said were pro-growth, was that President Obama would be elected and we'd add high-income surtaxes, basically as a way to reduce the deficit pressure. The net effect, even in these macro models, presumably would be negative. So how you close the deficit?
Over what horizon?
Well, say over a horizon of 20 years.
The score's over 10. I mean, and that's no, but I mean that's.
But you're saying this is good for growth, but if it actually makes the economy worse off in the long run, isn't that relevant?
Yes, it is relevant, and policymakers have been told a million times by CBO that this is something they should care about. But the job is to provide budget numbers for the window that they have elected. And you can't cure all problems. And a great mistake is for the staff to get this idea that we can somehow trick them into doing the right thing if we just show them the right numbers. That is a terrible place for staff to go. That's not their job.
Henry Aaron.
An observation and a question. The observation, Doug, is I think you've given the wrong answer just now. If there is a tax cut, eventually, or a spending increase, eventually there has to be payment for it, yes, either through something on the other side of the ledger or through interest payments, the present value of which is identical to the shift. If you are using a 10-year window, you have run afoul of what you countered at the beginning. You don't want to be exactly wrong, because that is exactly wrong. Even if it is the legal window.
No, let me be clear.
Let me come to the question.
We actually did this. So the way you do it is outside the window, you have an offsetting policy, and you always use the same one.
But it has to be incorporated into the estimated effect of the policy.
There's no question about that.
Okay, well then the 10-year window is irrelevant. So the question I have is I'd like to suggest a practical policy which I think passes the threshold test. Let's put together a combination of constructive realization at death, the President's proposal, and a restoration of the estate tax as it existed before the 2001 legislation. So a much lower exemption and a higher rate. I think in combination that revenue would be sufficient to pass the threshold. all of which is used to cut corporate tax rates. Do you have any inkling as to what the sign of the effect of that would be on economic growth?
I'm not sure I understand the policy. I won't try to make one up on the top of my head.
The policy is quite clear. It's an increase in taxation at the time people die of capital gains, as the President has proposed, and a reduction in the estate tax exemption and an increase in the estate tax rate, quite large, so that arguably if there are effects on behavior, these changes would be large enough to affect behavior. I'm not sure what the sign of that policy would be all by itself, but I wanted to combine it with using all the revenue to cut corporate tax rates so that it has a zero impact on the budget. Can you suggest that there would be what the sign of the effect might be of that change?
Let me simplify the question. So you maybe
How big is it?
So let's say there's a huge increase in the estate tax and a huge cut in corporate tax rates. And Henry's suggesting it's hard to tell the effect on growth.
My instinct is that's going to be positive for growth, and I'd be happy to work through the numbers. But you need that's what the staff would have to go through. Well, it would have to. That's what I was saying. The magnitudes matter.
So it doesn't have. If the deficit, I'm not sure how the rule works. Maybe we can bring this up later.
It's the GDP effect, right?
Is it
Net or gross?
Is it net or gross? Gross.
Gross.
So if you raise $100 billion of taxes and you cut $100 billion of taxes, the net effect on the deficit is zero, but it's big enough to trigger the rule.
Yes.
No, it would.
It would because
you shift around enough money. It's not the net; it's the gross. No, the total. Add up all the pluses and add up all the minuses, and if the pluses or the minuses add up to a big enough swing, we'll get this later. Wait. We can't wait. All right. First of all, hold this question because the people at JCT will be able to answer more precisely how the rule works. Short, briefly. Wait for the mic, Henry, and be brief.
Okay. Very brief. The answer has to take into account open economy consequences, exchange rate effects. You may think there's uncertainty about domestic macro models. The uncertainty with respect to open economy models is vast and depends sensitively on the response of other countries. So I think one is on very shaky ground.
Revenue estimate on corporate taxes as well. You have to, if you don't think about what the rest of the world is going to do. So your point is it's even more complicated if you have to think of growth. I think we have time for another question if there is one. If not, there's a woman right here, and then we'll go, and we'll have time for questions at the end, so you still have a shot.
Hi there.
You are?
Sure. Laura Blessing. I have a very basic question, and then I have a question for Mr. Holtz-Eakin. Okay. The basic question may be reiterating yours from earlier. Given that since the mid-'90s, the Republicans have been trying to get dynamic scoring in after they won the '94 elections, and it's always been an option to have it in addition to the projections that are already provided by the CBO, right? So are we going to use dynamic scoring for literally every bill instead of the magnitude we've discussed, instead of the regular scoring? Or are there going to be cases where we're still going to also use the regular scoring as well? This gets to your point about when we just literally can't tell. I don't know if it's always an add-on, or always a substitution, or what. So,
okay.
And the basic question, and I legitimately hope this doesn't sound like a gotcha question because it isn't. But Mr. Holtz-Eakin, I've read previous remarks of yours that have been critical about the use of dynamic scoring or the efficacy of it, particularly talking about the difficulties with using it, particularly in debt when the deficit is going up or in debt situations. And I was hoping you could provide whatever nuance I'm missing because I've been following dynamic scoring, but not your specific remarks on dynamic scoring.
I think on the basic question, I'll say what I know, and then we can ask the JCT people later. But basically, the rule says if the bill is large enough, JCT and CBO should dynamically score it in the official score to the extent practicable. And I don't think anybody knows exactly how that's going to work in practice. But it's required for those big bills in the House.
And I would supplement that with, I think, the suggestion that you provide both the dynamic score, which is the official score, but also the information on what the static one looked like is perfectly sensible, so you'll know.
Right. Okay.
So I think that's right. On the issue of debt, this is the issue of what do you do with offsets to deficit increasing policies, big spending increases or tax cuts that don't balance over the long term. And it does have to balance over the long term, and we're proving as a country that we have no interest in balancing over the long term. So I'm interested in at least doing it in the models. That's a matter of, that's not, quote, easy. The point is, there are lots of things that are going to have to be decided on operational things. Like, what do you do with the Fed? Well, put a Taylor rule in and have them always use the same Taylor rule no matter what. What do you do with out-year deficits? Have an offset policy somewhere out there at year 20 that you always trigger. Do it the same for every piece of legislation. These are things that I think are genuinely real and have to be dealt with, but they're not insurmountable and don't disqualify dynamic scoring from providing some information that Congress could use.
Do you want to have a quick response before we turn it over to the next panel?
I would agree with Doug, except I would do the deficit offset in year 5.
Okay. Bill and Bill Gao is going to introduce the next panel, and we're going to hear from JCT. So thank you very much, guys.